Thanks, Tim, and thanks for the opportunity to talk through the gold outlook, and not just for, importantly, the next day or the next week or the next month or quarter, but actually I want to map out today over the course of 10 minutes and about 12 slides where we see gold trending over the next 2 or 3 years. So quite a journey we'll be on. The presentation is, the title is To Infinity and Beyond, and I've linked that back to one of my favorite characters from Toy Story, which came out in 1995. And the symbolism of that is that in 1995, the gold price was somewhere around about $300 per ounce, and had been in that level for quite a long time. And you know, where we are today, about 6 times that level. We've been on a journey, a quite interesting journey in both 2005 and 2009 through 11. And we're about to embark on another extraordinary journey in gold. So that's the backdrop. And with that, Tim, can I go to the next slide? So that's a gold price chart going back to 2000 in US dollar terms. So it's pretty easy to look at that chart and go, gee, we had a peak in about 2010, around about $1,800 US per ounce. We're getting close to touching that level again now. You know, is it all over? Are we there yet? And I wanted to leave with you very clearly today, the journey is just starting, and we're embarking on a multi-year journey for gold price. Gold price will eclipse the previous high in 2010-11 within the next days, weeks or months, and then we'll push through 2000 at some stage in the next 6 months to 12 months, and we'll make fresh highs in the gold price over this journey. So with that view, I just want to drill down a little bit to say what's happened over the last 5 years, because the gold price has already been on quite a journey, and we're about to embark on another stage. So starting from the low point, so back a slide please, Tim. In 2014-15, we had the rally in Aussie dollar gold price, which took the gold price off its lows, and we saw the Australian miners start to tick up in value. The second stage we saw around about 16-17 was when the mid-cap sector started to emerge. There was a lot of M&A activity, majors leaving Australia and some of the mid-tier stocks buying up assets and building their portfolios. And most recently, we've seen the trend in US dollar gold price, very much reflecting an easing in the US dollar. But from here, and I want to leave a key date with you, March 23, 2020 was the key date in this new journey we're on, which is part 4 of this journey. And next slide, please. Why is that important? And the next couple of slides, I'll talk a lot about interest rates, but particularly real interest rates. So interest rates adjusted for inflation. And that's critical because when interest rates in a real basis are negative, the gold price will rally and rally substantially. The chart in front of you now is a long-term chart, one of my favorite charts. It goes back 700 years, and it just highlights the trend in real interest rates over that period. They've been in decline for a long period of time. But importantly, where we're at today is not just do we have low rates, but we have negative real rates. So next slide, please. This is a short-term trend going back to 2008, so picking up the GFC and now. And that's an interest rate chart looking at real interest rates. And what I wanted to draw your attention to is the 2 periods where the rates have dipped into the negative. And I'll talk next slide about the correlation to gold price. But the importance is when real rates negative, the market will start looking for yield, and gold becomes very topical and will start to appreciate. So that's the key backdrop. That's the key slide and thematic. We've had negative real rates 6 times since 1970 when the gold standard changed. The oil price shocks of 73 in the late 70s, post the share market crash in the late 1980s, 2005, 6, again in 2009 through 11, and again most recently this year. But again, the key date and the key driver behind this story on gold is what happened on March 23. Next slide, please. So March 23, the Federal Reserve, in concert with global central banks, announced that they would do, and I quote, whatever it takes to see us through this current pandemic, the COVID-19 pandemic. In doing so, they were lowering interest rates across the globe to in some cases negative, to in some cases very low, with the US at 0.25%. And importantly, with inflation running around about 0.8 to 1% at the moment, we've got negative real rates. This slide highlights what happens when, the correlation between real rates and the gold price. The black line is the gold price on the left-hand y-axis, and the right-hand side y-axis is the real interest rates. I've inverted that scale to give you the correlation, and that's the red line. And you can see the correlation of the two. They're well correlated, and that chart is moving towards the up-hand left-hand corner at a rate in line with real interest rates. So next slide, please. Next slide. If I could just drill down to short term, that's the last 6 months of that previous slide, and you can see that trend in real interest rates and the US dollar gold price. Again, the real interest rate is red and that's inverted. But you can see that trend is moving from the lower left-hand corner to the upper right-hand corner. And you can see on that journey over the next 3, 6, 9 months, we'll breach the current or the former high at that $1,800 level, and we'll take out the $2,000 level and we'll move substantially higher beyond that as well. So next slide, please. So I've tried to wrap around that view. Where does gold price go? Where does this journey take us? So in doing so, I've looked at the last gold price inspired real negative rate journey we had, 2009 through 2013. And there's a lot of data on this chart, but the two key lines to focus on. The red line is the profile of the gold price on a quarterly basis from 2009 through 2013. The black line is the gold price I am forecasting from now through 2024 on a quarterly basis. And I've just tried to marry the profiles of the two. The left-hand y-axis is the prices that we saw back in 2009 to 2013. On the right-hand y-axis is the prices that we could expect to see over the next 3 or so years. Importantly, the key message here is that gold did not spike for a particular day or a week or a month or a quarter. Gold remained elevated at a plateau for around about 5 or 6 quarters. Back in 2011 at around about the $1,700 an ounce level. Looking ahead, we see that level will be more like $2,000 average plateau, if not higher from here. So thinking about the context, this is not a spike like we see in some commodities. This is a long journey with a particularly long plateau as well. Next slide, please. So what does the equity market currently think gold price will do? This slide has 3 lines. The green line is the current spot price of gold. The blue line is what I'm currently forecasting on an annual basis out through 2023. And the red line is what I understand the current market consensus gold price forecast on an annual basis is out to 2023. Importantly, I think all those numbers are come substantial upgrades. As I mentioned, prices moving through the former high, up through $2,000 and potentially beyond to make a fresh new high. So those numbers are all come upgrades. Typically, the cycle in this industry is we upgrade every quarter. So you get these quarterly upgrades to the commodity price gold, but also underlying equities earnings. And that would be a positive driver and catalyst for share prices for an extended period whilst that upgrade profile is underway. So again, substantial upgrades from here to consensus numbers and spot. Next slide, please. So this story, as I've just mapped out, hopefully it's caught your attention and it looks compelling and interesting, but how much is priced in? It's great for me to pitch a story which is interesting, but if it's already known by the market and broadly talked about by taxi drivers, it's probably in the price. So where are we now? So these two charts highlight both the equities on the left-hand side, performance, and Tim mentioned this in his opening remarks, and on the right-hand side, commodity performance. It's year-to-date in both cases, and it just highlights where gold sits. The left-hand side slide has 50 of the top mining companies in Australia. You can see 12 of the top 15 performers year-to-date are gold companies, all the names we have here today. And on the right-hand side, gold price, other than a few esoteric or very bespoke commodities like uranium and manganese and the Baltic Freight Index, gold's been the best performing commodity. So you'd think a lot of this is in the price, but given the backdrop I've just mapped out, this is a multi-quarter, multi-year journey. We will see substantial further gains from here. So we're on a journey where we'll see fresh highs, which we've just seen. We may consolidate and make fresh higher lows, but we'll make fresh highs again from here. Next slide, please. So taking this down a step from the commodity level to the equity level, what does it mean to equities? And these are what I term bubble charts I publish in all of my research. They try to take 2 dimensions and put them into one chart, which is valuation on the x-axis, which is measured by price to NPV as a valuation ticker. And on the y-axis, trying to marry that on that second dimension in terms of share price performance, measured as 0 being the 52-week low and 100% being the 52-week high. As you can see on that basis, you start to get aggregations or groups of stocks. The top right-hand side, not surprisingly, gold names and also iron ore names, 2 of the best performing commodities over the last 3-6 months. The lower left-hand corner, some of the laggards, the energy stocks, some of the industrial commodities like nickel and copper that haven't yet caught a bid at this stage. But on the right-hand side, to maintain a valuation which is starting to look full and a share price which is starting to punch new highs, you need to have a continued tailwind. So just looking at the dichotomy there in that top right-hand corner, I mentioned iron ore and gold. We see iron ore fading over the course of the next year, but we see gold continue to rally, as I mentioned. So those gold equities have still got a great tailwind from here, so they can stay and will stay in that upper right-hand quadrant for some time yet. Next slide, please. I should say that last slide was my deck of equities that I cover. So 18 commodity company names, of which there are 5 gold companies in that list. This is a bit more a busier chart, the same idea. It's taking 50 stocks and putting the same data set around that. So the valuation on the x-axis versus the share price performance on the y-axis. Key to that, again, is that the gold names are all in that upper right-hand quadrant, and they will all stay there and graduate or gravitate towards that corner for an extended period of time, potentially over the next couple of years. Next slide, please. You know, how do gold equities perform versus the Aussie dollar gold price? They're pretty well correlated. And one of the key takeaways as an analyst I'd give you, and one of my trade secrets, is that it's pretty easy to predict where company share prices go if you can just work out where the commodity goes, because on 95% of the time, the commodity equity will follow the commodity price. So in terms of gold equities, I'll be following the gold price higher over the next couple of years on this journey. Next slide, please. Just to wrap up with the deck of coverage that we have here at Shaw&Partners, as I mentioned, 5 names with some of the speakers that we have here today. And it's on that slide, you'll see our target prices, our expected returns, which at this stage rank about 36% over the next 12 months. But importantly, I wanted to steer your eye towards the right-hand side. I've given a trajectory as a base case where we see the upside in share price, as I mentioned, 36%, but also a potential upside case where we see valuations start to stretch to what we've seen in previous cycles. And that could be at a level of 2 times their underlying value, which could see the likes of a Newcrest at $55, likes of a Northern Star at $25, and a Ramilius would be at $3.24-ish. So, a journey, as I said, not weeks, days, or a quarter, but multi-year. Prices taking out the previous highs and through 2000 and above, and equities following that journey higher for an extended period of time. So the gold equity space is a place we'd like to be. We're overweight at Shaw&Partners in our portfolio and our recommendations, and we think that's a place we'll be for some time yet. Thank you, Tim.
Great, thanks, Peter. Great presentation. Can I ask a question about, we've got a question about demand. So we assume the gold price is rising in turbulent times like this, but where is the actual demand for gold coming from?
Well, interestingly, one of the key drivers in the next little while will be ETF buying. As we see, it's correlated to gold price moving higher, there'll be more money flowing into ETFs, which has traditionally been a demand driver. But beyond that, there'll be industrial demand, which should post-COVID return to normal. And the jewelry season in India, again, post-COVID will return to normal. So demand, like most commodities, is affected at the moment, but on again, that multi-year view, we see demand resuming a normal trajectory and squeezed a little bit higher and juiced up by what we see happening in ETFs as well.
Yeah, I was actually talking to one of the ETF providers. I think they've had almost $500 million worth of inflows into one of the gold ETFs recently. And where do the kind of the Federal Reserve banks, where do they stand in terms of their gold ownership? There's always these conspiracy theories about them being underweight gold.
Yeah, look, it's interesting. There's been net buying of gold by certain central banks and selling by others. So it's a little bit of a mixed bag at the moment. But interestingly, Russia is adding. China, last I heard, we're adding. The US seems to be stable, but we see some European countries reducing. So it could be a function of price, but gold reserves on balance look to be stable to moving higher in the short to medium term.